Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 5th of November. I'm Daniel Lam, your host for the podcast. One of the key ideas that we talked about yesterday was gold miners, which we see as a higher beta instrument to express a bullish view on gold. Now we see three key structural drivers for gold to go higher: geopolitical uncertainty, concerns about expansionary fiscal policies worldwide, and increasing doubts about the Fed's independence. Now, for the short term, liquidity continues to be a key driver. With the Fed undergoing its rate-cutting cycle, liquidity has been abundant and likely to continue to be so. Liquidity can explain why gold has been delivering outsized moves compared to Bitcoin, with both being alternatives to fiat currencies. Moreover, cross-asset volatility is low, and in such an environment, the cost of liquidity is also not high and supply of that is abundant. Now, is there any adverse news for gold? Well, we believe in the very near term, it can still trade on the weaker side, which presents an adding opportunity. For example, China has removed the full 13% VAT rebate on gold jewelry sales, effective the 1st of November. That had been in place since 2002. Now, while this change will increase government revenue, particularly given record gold prices, there are concerns that it would dampen overall demand. As the leading global consumer, China's substantial jewelry demand has acted as a buffer to gold prices when investor appetite has eased. China's jewelry demand accounts for 22% to 31% of global jewelry demand over the past 15 years, and 15 to 28% of bar and coin demand. In terms of China's consumer demand that we can track, jewelry demand made up 55% in the third quarter of 2025 versus 83% in the first quarter of 2022, and also 36% of China's gold imports. Now, China's jewelry demand has been under pressure in recent years as growing consumer wealth and market liberalization gave way to high prices, slowing economic growth, and a generation shift in preference and a property sector downturn, all of which weighed upon sentiment. Demand in 2025 is 40% below its 2013 peak in tonnage terms. But any weakness that we see in gold, we see as an adding opportunity here. Apart from liquidity and the structural drivers aforementioned, gold continues to be under-allocated by many investors, retail and family offices alike. We see 7% as a good level of allocation to a balanced investor. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.